Well, hello everyone and welcome to Moementum channel. My name is Mo, and in this video, we're going to be talking about 6 high quality dividend paying stocks that are considered to be fast dividend growers and at this time are reasonably valued. Without any further ado, let's get into it. All right, our very first pick is Bank of Nova Scotia with ticker symbol BNS. It is a Canadian bank, but it is available also in US dollars through New York Stock Exchange. The market cap for Bank of Nova Scotia is at $83.7 billion, making it a large cap company. From a volatility perspective, the stock for Bank of Nova Scotia has a beta of 0.68, suggesting low volatility, which is just ideal for dividend investors. As indicated, Bank of Nova Scotia is currently considered to be reasonably valued, and it has a price to earning ratio of 10.7, which is above 5-year average for its own stock. As for dividend yield, we are looking at a dividend of 4.48%, and it has a dividend safety score of 70, making it a safe dividend stock at this time. And the last time that the stock and the company, in fact, increased its dividend goes back to November of 2021, where they increased it by 11%, making it a fast dividend growth at the time. That being said, though, for Bank of Nova Scotia, they have had some pause to their dividend growth increase, and this is the first year that they are increasing it after some pause in their dividend increase, though the company has been paying its dividend uninterrupted in the past 25 years. Bank of Nova Scotia does pay its dividends quarterly, and it is paid in the month of January, April, July, and October, and it has a payout ratio of 45%. From a cash flow perspective, Bank of Nova Scotia is showing positive free cash flow in 3 out of the last 10 years. And during the recession years of 2007 to 2009, the company did maintain its dividend payments, while the stock for BNS was down by 61% during those recession years, which trailed behind the S&P 500's negative 55%. Looking at the past return for Bank of Nova Scotia, the 1-year return for the stock is at 13.04%. The 5-year return is showing to be at just above 20%. All right, our second pick is another Canadian company called Canadian Natural with ticker symbol CNQ. It is in energy sector. It is also available for investors outside of Canada with ticker symbol CNQ, available for being traded and bought or sold. It has a market cap of $73.3 billion, making it another large cap company. It has a beta score of 0.82, suggesting average volatility for this stock. The dividend yield for CNQ is at 3.72%, and it has a price to earnings ratio of only 7.8, which is below its own 5-year average, suggesting this could be a very good time for investors to consider adding to their shares of Canadian Natural if that interests them. The dividend safety score for Canadian Natural is at 70, making it a safe dividend payer. And the last time that they increased their dividend goes back to March of 2022, where they increased it by 28%, a very fast dividend growth. They have been paying their dividend for the past 20 years, and in all of those years, they have increased it year after year. Canadian Natural does pay its dividend quarterly in the months of January, April, July, and October. And it has currently a payout ratio of only 33%. From a cash flow perspective, Canadian Natural is showing positive free cash flow in 7 of the last 10 years. And during the recession years of 2007 to 2009, they managed to continue to increase their dividend amount. As for the stock return, during those years, the stock was down by 54%, which is very close to that of S&P 500's return of negative 55% at that time. Looking at Canadian Natural Resources stock return, the 1-year return is an impressive 108.8%, and the 5-year return for the stock is close to 92%, which is just a remarkable return. All right, our third pick here is another financial institution, Toronto Dominion Bank. Despite being a Canadian bank, Toronto Dominion Bank is also active in the US market, and it has $139 billion in market cap, making it a mega cap sized business. From a volatility perspective, TD has a beta score of 0.70, suggesting a low volatility for this stock. The dividend yield currently for Toronto Dominion Bank is at 3.62%, and the price to earnings ratio is only at 11.6, which is above 5-year average. However, it is better than that of the average price to earnings ratio for financial sector. The dividend safety score is at 80, making it a safe dividend payer. And the last time they increased their dividend goes back to December of 2021, where the TD Bank increased it by 13%, making it a very fast dividend growth. Toronto Dominion Bank has been paying its dividends uninterrupted for the past 27 years, and in the last 11 years of those, they have increased it year after year. Toronto Dominion Bank does pay its dividend quarterly in the months of January, April, July, and October. The payout ratio is only at 39%, which is considered low for banks, giving Toronto Dominion Bank a ton of room to increase its dividends for the years to come. As for cash flow, Toronto Dominion Bank shows positive free cash flow in 2 of the last 10 years. And during the recession years of 2007 to 2009, they did maintain their dividend at its levels at the time. As for the stock return during those years, the stock was down by 63%, which trailed that of S&P 500 negative 55%. Looking at the stock return, the 1-year return for Toronto Dominion Bank is at 16.5%, and the 5-year return is close to 57% return. Our next pick is Amgen. It's a healthcare business with ticker symbol AMGN. It's a US business active in this field with a market cap of $134 billion, making it a mega cap business. With a beta score of only 0.52, suggesting low volatility, Amgen does pay a dividend yield of 3.06%. Their price to earnings ratio currently is at 14.4, which is in line with their own 5-year average, and is showing a safe dividend score of 74. The last time that Amgen increased its dividend goes back to December of 2021, where they increased it by 10%, considering to be fast dividend growth. Amgen exactly has been paying its dividend for the past 10 years, and in all of those years, they have increased it year after year. Amgen's dividend payments are made quarterly in the months of March, June, September, and December, and they have a payout ratio of 41%, which edges slightly higher for biotech businesses. However, it is still within the acceptable range for us, being lower than at 60%. As for Amgen, they have been showing positive free cash flow in each of the last 10 years. Because they have been paying their dividend in the past 10 years, that's why that we don't have any records of their dividend payment during the recession years. However, as for the stock return during the recession of 2007 to 2009, the stock was down by close to 19%, which is much better performance than that of S&P 500 when they had a negative 55% return. Looking at Amgen's stock return, the 1-year return currently is at only about 2.2%. However, the 5-year return is at a more decent 55% return. Our 5th pick, we have a consumer staples business called JM Smucker, the ticker symbol SJM. SJM does pay a dividend currently at 2.85%, and it has a very, very low volatility stock with a beta of only 0.13, suggesting a perfect pick for investors who do not want a ton of volatility when it comes to their investments. JM Smucker has a market cap of $14.9 billion, still making it a large cap size business. With a dividend safety score of 96, the stock and its dividend is considered to be very safe. The last time they increased their dividend goes back to July of 2021, where the dividend was increased by 10%. James Smucker has been paying his dividend uninterrupted for the past 29 years. And in 19 of those last years, they have increased it year after year. The dividends here are paid on a quarterly basis in the months of March, June, September, and December. As for payout ratio, we are looking at a payout of 45%, which is low for consumer staples, again, giving this business room for continuing to increase its dividend for years to come. And to add to that, look at the positive free cash flow in all of the last 10 years, which is just remarkable. During the recession years of 2007 and 2009, James Smucker actually continued to increase its dividend, a remarkable sign of a healthy business. And as for the stock return, it was down by 27%, although a negative return, it was definitely way better than that of S&P 500's negative 55%. Now, let us take a look at the stock return for SJM, the 1-year return is at 8.3%, and the 5-year return overall is at only 7%. The 5-year return probably is not the most amazing. However, if you look at the chart, there are cases whereby the stock has had ups and downs. It's almost like the stock has some pullbacks at certain time frames, and those could be wonderful opportunity for long-term investors to invest in the stock. If you look at the longer-term horizon, for example, 10-year though, the story is much better when you're invested for a long period of time. Here, you're looking at a 10-year return of 74 point, close to 4%. And lastly, our sixth pick is a healthcare business called Bristol Myers with ticker symbol BMY. It has a market cap of $164 billion, making it a mega cap size business. And of course, another low volatility stock with a beta of only 0.26, suggesting very low volatility for Bristol Myers. Dividend yield here is at 2.78%, and the dividend safety score is at 79, suggesting a safe dividend stock. Price to earnings ratio is at 10, which is in line with the 5-year average for Bristol Myers. Looking at the dividend payment history, Bristol Myers has been paying its dividend for the past 31 years, and in the last 15 of those, they have increased it year after year. Last time the Bristol Myers increased its dividend goes back to December of 2021, where they increased it by 10%. Bristol Myers does pay its dividend quarterly in the months of February, May, August, and November, and they have a payout ratio of only 27%, which is considered to be low for biotechs, giving them a ton of room to increase their dividends. On top of that, they are showing positive free cash flow in all of the last 10 years. And during the recession years of 2007 to 2009, the company managed to maintain its dividend amount. As for the stock return during those years, the stock was down by 32%, which is better than that of S&P 500's negative 55%. Lastly, if you look at the stock return for Bristol Myers, the 1-year return is at 25.5. The 5-year return is at close to 46%. And if you look at longer term horizon, 10-year return for Bristol Myers is at close to 140%. Just incredible. Well, there you have it, folks. A quick look into 6 high quality dividend paying stocks that are considered to be reasonably valued at this time. And of course, they are all very fast dividend growers. Do you have any of these stocks on your portfolio right now? We would love to hear from you. So leave us a comment down below and share with us whether you have any of these stocks or any other dividend stock that you are a fan of. We would love to hear from you. If you enjoyed this video and gained something of value from it, please give this video a thumbs up and share it with someone else who might benefit from the videos. And of course, don't forget to subscribe to our channel. Here on Moementum Finance, we post every week several videos about investing, whether it's investing in the stock market, including dividend stocks or growth stocks, as well as ways to reach financial freedom. We also touch on ways to invest in the stock market passively through ETF investing. We have a ton of materials and videos that you are sure to gain some value out of. So be sure to check them out if you haven't done that already. With that, thank you so much, and I hope to see you next time.